Okay, so let's talk about research and development costs. First off, what is an R&D cost? For the CPA exam purpose, all you really need to know is that research costs are anything related to gathering new information related to developing a product. And development costs are essentially anything related to the design, anything related to the testing, or anything related to the production of a prototype, if I had to put some buzzwords on it, of a product. And it's going to be all encompassing. So employee salaries that are related to researching new information, employee salaries that are involved in testing a product, the materials that are involved in creating the prototype, the electricity that's used to power the computers you're coding on. That's all going to be encompassed under R&D costs. So R&D costs is this general term that I hope you'll be more familiar with by the end of this lecture, what exactly the CPA exam means when they say a research and development cost. Something to note, though, what is not a research and development cost is market research. Just because it has the word research in there, don't get confused. Market research is going to be a marketing expense. It is not a research and development cost. CPA exam loves that because it has the word research in it. They think people will get confused, and they do. So just know, market research is a marketing expense, not a research and development costs. Okay, so how do we account for research and development costs? Well, the general rule is that we expense them as they are incurred. R&D costs expensed as incurred. And it's called a general rule because there are exceptions. And the CPA exam loves exceptions. And you're likely going to get tested not on this general rule of expensing R&D costs as they're incurred. You're going to get tested on the exceptions. So let's go over them. The biggest one by far is computer software costs. Costs related to the research and development of computer software. And there's two kinds. There's computer software developed to be sold, leased, or licensed. So you're talking about something like Microsoft Excel. Microsoft is developing the new version of Microsoft Excel for the explicit purpose of selling the product or licensing it to universities or things like that. And then you have computer software developed for internal use. So you could have Netflix developing their movie recommendation algorithm for their product. That is something that's an internal use software that's being developed. It's just for their product. It's for their company. They're not selling it to anyone. So there's a distinction to be made there, and there's a distinction in how we account for these two separate instances. So let's take a look at that. First off, let's start by looking at the kind of computer software that we're developing to sell. So the Microsoft Excel, if you would. The rules for accounting for this, first off, expense the costs as they are incurred until this arbitrary thing called technological feasibility. What do they mean by technological feasibility? Because you'll see this word related to computer software costs. What they really mean is that the thing works. I mean, that's the simplest way to put it. Technological feasibility means the thing works. The whole logic in expensing R&D costs and not capitalizing them is that they're not really associated with any probable economic future benefits. So when we're saying we're going to expense them just to be safe, but once you have technological feasibility, once the thing works, then all right, there's going to be some sort of future economic benefit here. So that's now when it's okay to capitalize the costs. So we're going to expense them until the thing works, and you'll just see it written on the exam as technological feasibility. We'll expense them till then, and then we're going to capitalize all of our development costs. And we're going to capitalize costs until the product is ready for sale. Once the product is ready for sale, we're going to stop capitalizing costs, and we're going to begin to amortize. We're going to amortize the cost of this intangible asset that we had been capitalizing. And the way that we amortize it is we amortize using the greater of either percentage of a revenue or straight line amortization. And we'll look at that in a little bit more detail in just a sec. I just want to go on an aside real quick and make a note. When we're talking about computer software right here, we're talking about research and development costs only. Costs related to actually producing the product. So once they're done with Microsoft Excel and they start lasering it onto a physical CD-ROM, that is a manufacturing cost. That's going to be part of inventory. That CD, that physical CD that they're making, that's going to be an inventory. So these are only costs related to the research and development of the software. The actual producing the software, that is all inventory. It's manufacturing or packaging expense. It's not related to R&D. So keep that in mind. You got to be careful of it. And this intangible of capitalized software costs are going to be reported as separate items on the balance sheet. And you report them on the balance sheet at the lower of either cost or net realizable value. I have never seen that as a practice CPA question or anywhere in the CPA exam that someone throws out the lower of cost or NRV on the balance sheet for your capitalized software costs. That would be a real zinger, but it is part of US GAAP, so you do have to know it. Capitalized software costs are separate line items reported on the balance sheet at the lower of cost or NRV. So let's go back to what we were saying before. There are three things that you do with these capitalized computer software costs. You expense them like normal until you hit technological feasibility. Then you're going to capitalize the development costs till you're ready to sell the product. Then you start amortizing as either the greater of, percentage of revenue, or straight line. And let's look at exactly what we mean by that so we're perfectly clear. Let's look at a fact pattern here. We have capitalized computer software costs of $1 million. Economic life, 4 years. And we have some revenue projections. So in year one, we're going to get 2.5 mil revenue. Year two, 1.5 mil. Year three, 750,000. Year four, 250,000. Total of $5 million revenue is expected from this. So using straight line amortization, all I'm going to do is take the capitalized costs, divide by the economic life, and that will be my amortization per year. So in year one, I would amortize at 250,000. Using the percentage of revenue method, I actually need to know the specific projected revenue or the actual sales, which is going to be what you're going to normally see on the CPA exam. Actual sales, probably more so than projected revenue. This is the same thing. So my projected revenue here is 2.5 million out of 5 million total, which is 50% of the total expected revenue I'm going to incur in year one. So I'm going to multiply that 50% by the $1 million capitalized costs to get the amortization for year one, 500,000. So remember, it's actual sales as a total of total expected sales. That's going to be a percentage. Multiply that by the capitalized costs. You're going to get an amount of amortization for year one. Compare it to the straight line. Take the greater, and that's how you amortize computer software costs that you're going to sell. So in this case, 500,000 greater than 250,000, I would record $500,000 as amortization in year one on my computer software as a separate item as a separate line item on the balance sheet. So that, I think, is pretty simple to remember. It's got that little curveball of greater of percentage of revenue or straight line. Let's take a look at computer software that we develop internally. So we're developing it for internal use, the Netflix algorithm, something like that. Well, first off, we're going to expense costs as incurred until the preliminary project state, which is technological feasibility. Yeah, you'll see a couple terms for this, but pretty much it just means the same thing. It's technological feasibility. Then you're going to capitalize all costs incurred. None of that until ready to sell, because you're not selling it. You're developing it internally. So once you hit preliminary project state, you're capitalizing all costs incurred, including upgrades, everything like that, because there is no ready to sell. You're not selling it. And then you're just going to amortize using the straight line method. So always straight line method with internal software, and the greater of percentage of revenue versus straight line for external software that you're going to sell. So what happens, though, if you change your mind? So say Apple Computers is developing some sort of database that they're getting all the Siri queries in, this voice record dictation technology where someone can speak and it'll record it and parse the data. And they're developing it to use in Siri. And then they decide, hey, we got something pretty substantial on our hands right now. This is great technology to parse voice and get voice recording into text. Let's license it. This is great technology. So they'd been capitalizing all the costs incurred as they would for internal software. Then they change their mind and they're going to say, let's license it to the United Nations so that they can help with their translation work. So what do you do now? Well, first off, you're going to start expensing things because you've been capitalizing all the costs up until now. Now, if you suddenly have selling expenses, marketing expenses, these are things that you're going to need to start expensing, and you're going to recognize revenue using a cost recovery method. So if Apple has a capitalized software cost of $10 million related to this database they were creating for Siri, and they license it to the United Nations for $8 million. You are going to debit cash $8 million, credit asset $8 million. You will not record any revenue. You are going to write down, you're going to net the cash that you are getting from licensing or selling against the asset's value. So now the asset will have a value of $2 million, and say they license it again to a defense contractor for $3 million. You're going to debit cash $3 million. You're going to credit the asset $2 million down to zero, and then you can start crediting revenue. So now they're going to credit revenue for $1 million. So once they recover the cost of the software they developed internally, now they can start getting revenue for it. So that's the I changed my mind scenario. That's it with computer software costs. A couple things just to keep in mind. Let's go